The U.S. CEO of BNP Paribas, Jean-Yves Fillion, joining us here in a CNBC exclusive. Welcome.
Thank you for having me. Pleasure welcome. To be here.
Nice to have you.
So, in honor of your appearance here, the president has just tweeted, and maybe in mine a little bit, about the currency market, saying the euro is dropping against the dollar like crazy, giving them a big export and manufacturing advantage. And if the Fed does nothing, our dollar is now the strongest in history. Sounds good, doesn't it? Except to those manufacturers that make products for sale outside of the U.S. So here are the numbers. The euro is down about 3.4% so far this year. It is down 0.8% for the month of August, and it's down about 5.3% over the last 12 months. So it's significant. He's right. The euro has been weak against the U.S. dollar. What's your vantage point as the U.S. CEO of a French bank?
Well, listen, first and foremost, this economy is very strong. GDP, employment, consumer spending still, and that's a big factor in terms of driving investors to invest here. The second factor, which is really a consequence of central bank policies across the world and in Europe, in US, is the status of rates. You have still negative interest rates in Europe, and you have a fairly healthy, positive net margin interest rate here. Sitting bridging Europe and US, we've seen inflows of money coming in, which obviously support the dollar further, but it's more like a mechanical impact on central bank policies.
What about this view from the president that the Fed should do something about it, target the strong dollar because it is hurting our manufacturing? Would you agree with that, with the window into the economy?
I'm spending most of my days, and I love it, with US CEOs, with my clients, right? And what I can tell you is they have strong confidence in the day-to-day economy. I can see them moving. I can see them, pushing the business forward. Where there is uncertainty, it is when we speak about the medium term and the long term. You've seen a still significant trend in terms of share buyback, which I think explains a willingness, probably a safer a sentiment to return the value to shareholders versus investing long term. Then what I sense here is this uncertainty is not coming so much from the dollar or the euro. It's more coming from the uncertainty, which today is not so much driven inside domestically, but more like by global, geopolitical, political, and social tensions.
Is that increased over the last, let's call it 6 months, in terms of the CEOs you speak to here in the U.S. and their uncertainty, so to speak?
I think it has. And as you mentioned, trade has been a big factor. Let me share a live example here. I was with a U.S. CEO last week. He's leading a big, U.S. manufacturing company here. He's exporting to China. And he was explaining to me over the last, 12 months, he's seen tariff, going up and down, ranging from 15 to 40% down to 25. Impact on the P&L, managing uncertainty. In the meantime, he's importing steel, aluminum, same concept. That's what, CEOs, are trying to manage. We are spending, I can tell you, a lot of time at BNP being a lead, very house, in terms of advising, in terms of, promoting hedging strategies across rates, currency, and commodities.
Well, you also have a business in the capital markets, both advising U.S. companies, but also overseas, advising European companies. I'm curious, is there any demand at all for U.S. companies to try to borrow in euros overseas, given the negative rates? Is that an opportunity, or is that, for some reason, not something that really works?
It is an opportunity in many ways, David. You're spot on. It's an opportunity, first and foremost, in terms of investor diversification. Quite important, when one gets into more volatile times. It's an opportunity in terms of, locking in lower rates going forward. And as the lead bank in the Eurobond over there, we've been really, leading a lot of transactions there for large U.S. companies, but with international scope.
One of the questions as the markets now essentially price in a lot more Fed easing, or at least a couple more easing moves, is whether that would have much of an effect on these dynamics you're talking about. In other words, the cost of money seems not to be the main challenge for companies or consumers even. So would lowering rates that much more do much of anything, and do you still expect it?
Listen, I think there's a real discussion to have between lower rates and better, I would say, economic dynamic here. Listen, the only thing I can really see here is the Fed has more ammunition today to maneuver versus, most of the rest of the world. When you live in a negative rate environment, it's true for the Eurozone, it's true for part of Asia. This is more complicated to play with. As it relates to Europe here, I believe there is a potential next step here, which is not only monetary policy, but reflecting on maybe fiscal stimulus.
What do you think, though, the ECB is going to do next?
Well, they've been signaling, and I'm looking forward to this, that by mid-September, when they come up with their updated policy, that they are really willing to provide more stimulus. Then I think the world is really waiting to see how this strategy develops.
What does it mean for the European banks? I mean, one of the cautionary tales that we hear in this country is we don't want to go to negative rates. We don't want to go to zero. It destroys the banking system. And that's what's happening in Europe, and it's what's happening in Japan.
I think your point is extremely well taken, Sarah, here. If you look at European banks versus U.S. banks, I think they've recovered from their respective crises, 2008, 2011. I think they are better capitalized, more liquid, better managed, well managed on both sides. The main difference is, one is growth. Valuation is a factor of growth for any sectors. The second one is what you just mentioned. I think, being in negative interest rate, zone, they have to, billions of deposits with central banks, that cost money. But there is another factor I would like to highlight here. This is the capital markets. The main difference between the two regions, you have a vibrant capital market here. Capital velocity is amazing. And U.S. banks have this ability to recycle their balance sheet at a faster rate, better return, and better profitability. 80% of the funding in the U.S. is coming from capital markets. In Europe, the same 80% is coming from the bank. And that's maybe, back to ECB, there is probably going to be on the agenda one day as they manage to build and establish a joint currency and common currency, maybe building a European capital market union can be a good step forward as well.
Speaking of capital markets and overall investment banking, what are your expectations for the last 4 months of this year in terms of volume, in terms of activity here in the U.S. where you operate?
We still see growth here. Our economists are forecasting another, a 2.3% GDP growth here. And overall, the Fed continuing to be on the top of it and potentially providing stimulus might probably help the business going forward. Main question mark to me, uncertainty around geopolitics, politics, and social.
Thank you for joining us. Good to see you.
It's a pleasure to be here. Thank you for having me.
Jean-Yves Fillion, the CEO of BNP Paribas in the America.